how is the upcoming election going to impact your investment portfolio? What I want to do in this video is provide you a lot of the historical context. We'll look at the presidential cycle and how stock markets have performed during the different years of a president. We will look at S&P returns after election day, and we'll look at investment returns during election years as well. And then I want to kind of just provide you some historical context on how the stock market has done under Republican versus Democratic parties. We'll talk a little bit about just the different candidates and their policies and how those can sometimes impact stocks, and give you a little international perspective as well. My name is Scott Caulfield. I'm a CPA and a CFA charter holder and the founder of Sophos Wealth Management. All right, so let's dig in. How have stocks done during the different years? This chart from Morningstar will show you that during the presidential cycle, years 1 and years 4 are pretty typical returns. So US stock markets returned around 10% on average over time. So the post-election year, about 10.7%, and the election year, year 4, about 11.6%, shows that historically we would expect pretty normal returns in year 4 of the presidential cycle, which is where we're at today, as well as the first year going forward. I do find it kind of interesting. Year 2 is when returns are typically weak, and year 3 are when returns are pretty strong. Now, this next chart from JP Morgan is going to show how the stock market has performed during the actual election years. And from 1960 till 2020, you can see the performance has not been as strong as the 1923 to 2023 performance we saw in the last chart. So most notably, you had the big down years in 2000 and 2008. Now, I don't think that really had to do with the election cycle so much as it had to do with the stock market being expensive and what was happening in the global economy. But as you can see, most of the returns during those election years were fairly muted, so mid-single digits for the most part, outside of those couple negative down years. This chart shows the actual S&P 500 returns after election day. For whatever reason, the first day after election day has not been very great in a lot of cases. But if you fast forward to 1 year after election day, typically returns since 1984 have been pretty darn good. Lone exception there would be 2000. But again, the tech bubble was unwinding. It also had the added complication of a contested election and Florida and the ballots and all that stuff. But I think the real impact, the real reason the market was down was not was not the presidential cycle. It was the unwind of the tech bubble. Now, this chart is one of my favorite ones. It comes from Edward Jones, and this is going to show us the annualized returns during different US presidential returns. In general, you're not seeing big differences here, with two notable exceptions. So 1969 to 74, that's Richard Nixon, and 01 to 09, so George Bush. Those ones kind of stick out. I think 69 to 74 is maybe a rougher, more confusing period. You had a lot of things going on. So in the end of 69, you had the Nifty 50 stocks roaring higher. You had all kinds of kind of crazy macroeconomic events. Bretton Woods was coming to an end. Inflation's gearing up. I mean, you could argue some of those were political, but with the stock market starting expensive in 69 and then ending in a crash in 73, those are some of the real big reasons for the poor returns there. 01 to 09. So you think Bush stepped in right as the tech bubble was starting to unwind. He had the most expensive stock market of all time at that point. And so the first 2000 to 02, the market did horrifically. And I'd say that had nothing to do with politics and everything to do with an expensive bubble popping. And then for 08-09, as he finishes, we've got the global financial crisis. So stocks ended very cheap, very attractive. You could argue some of that, letting the housing bubble housing bubble first inflate and then pop. I mean, could a different president have stopped it? Potentially, but the odds that that would have actually happened are pretty low. I think no matter who was in office, no matter who was president, really high odds the returns would have been pretty horrific from 01 to 09. So in general, I don't think you're seeing a lot of differences in the political party in terms of returns. And I think when you see outliers, they're driven by different factors than who's in office. It's much much more important what's happening in the economy, what's happening with the stock market. And so, that kind of leads me to today's election. We've got Harris on the left, we got Trump on the right. We already know the stock market did great during Trump's first term. A lot of people would just kind of project that forward and say, well, won't he have a great second term? To me, look, it's possible that who's in office and their policies will impact the economy, will impact the stock market. But I don't think that that's really a very actionable thing. The reality to me is what's far more important is where's the stock market starting at? And to me, it's starting extremely expensive. So whoever's president the next 4 years or 8 years has a chance of overseeing some really poor returns because we're starting at such an inflated level. Additionally, I think what's far more important of a question than who wins the election is, are we going to go into a recession? We've seen rising unemployment. Arguably, the SOM rule has been triggered. You've got the yield curve, which was inverted a couple of years ago, all of a sudden potentially uninverting. These are some of those coincidental indicators that have kind of coincided with recession in the past. And so if we actually do in a recession here, I think that's going to have a far bigger impact than who actually becomes the president. I think it is interesting when you look at the presidential cycle in terms of how that impacts the economy. And I think a lot of times it can happen in ways that people don't necessarily expect. So first of all, I'll go back to when Trump was elected. When it was first looked like he was going to be elected overnight, stock futures were down big. I remember going to bed thinking, oh man, it's going to be a bloodbath tomorrow. And I wake up, Trump's still supposed to be president, and stocks ended up huge that day. When a president's actually in office and enacts a lot of their policies, the reality is that those things hit the economy with a pretty big lag. So even if they do make a difference, it may not happen in the way it impacts the stock market until down the road, or at least the economy. And then, I look at something like Trump was supposedly one of the most friendly presidents to oil and gas we've had in quite a while. His slogan still is drill, baby, drill. On the other hand, Biden was very antagonistic to oil and gas, did not want to give any new leases to oil and gas companies. And yet, one of the best, I actually think the number one performing sector of the stock market under Biden has been energy. Oil and gas, whereas energy was one of, if not the worst performing sectors under Trump. So the impacts that the president has on areas of the stock market does not always play out the way that you would expect. I think another important thing as we look at both presidents and both potential parties is they're both going to be huge spenders. We've got a massive deficit. The deficit as a percentage of GDP is truly unprecedented outside of wartime. And that is likely to continue no matter which candidate wins the presidency. So I think things like that, there's just not as big a difference as people think, at least in this election and at least on the stock market. Now, I do want to kind of hedge this a little bit because there haven't been big differences, in my opinion, in the US historically. But that is not always true internationally. And it doesn't mean that just because it's been this way in the past in the US, where there haven't been big differences, that there couldn't be in the future. So you'll see some Latin American countries, and sometimes if they take a hard pivot, let's say to a left or socialist candidate, sometimes that absolutely annihilates their stock market. They get massive inflation, they get all kinds of problems. So in those kind of emerging markets, elections have made a big difference. In fact, one of the ones I think that was a big positive for markets lately, I think it's kind of just a fascinating experiment, has been Argentina and Javier Milei and what he's done, really opening that up, taking a hard pivot to a free market economy and capitalism. It's been a real boon to their stock market. So there is the potential out there that a candidate could make a difference. It's just history doesn't really back it making a big difference in the US. And my personal opinion is it's unlikely to have materially different changes on the stock market returns that you should expect in your portfolio. The rule of thumb for the US has been don't play politics with your investment portfolio. And that's still kind of my base case. That being said, I definitely am worried about things like the stock market and the potential for the economy rolling over. So I hope you like this video. Please like it, subscribe to my channel, and share this with anyone that you think might benefit. Thanks a lot.